This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. And today, before we begin, I do want to remind you that there is a website associated with this podcast called wealthformula.com. Lots of things that you can get there in terms of resources. And one of the things you can do is sign up for the Accredited Investor Club. This is a group just called Investor Club on the website, which is really focused on trying to get people exposure to private investments. Private investments are things that are only accessible to accredited investors, those who make $200,000 per year, $300,000 if filing jointly. That has to be for at least 2 years with the anticipation of it continuing, or a net worth of $1 million outside your personal residence. And if you are meeting that criteria, you are an accredited investor and you can sign up for the Accredited Investor Club. Get exposure to private deal flow, lots of opportunities coming up this year. So join the club. Go to wealthformula.com. Okay, let's talk about something that people get wrong, which is the way to think about taxes. Now, the tax code itself isn't just a bunch of rules telling you, when you have to pay. In fact, mostly the tax code is telling you when you don't have to pay. It's telling you the opportunities you have in order to avoid paying taxes. And most of this is because the tax code is essentially a list of incentives, right? It is telling you in what case the government feels like you won't have to owe taxes. And most of the time that is because you're doing something that the government wants you to do, right? Now, my point in telling you this is that when we approach taxes, it is important not to be overly conservative. Now, I'll tell you that when I first started making money as a surgeon, I listened to some of the other surgeons, which is never good advice, never good financial advice to listen to other doctors, by the way. And they said, well, you got to go to this guy because he's really good and he won't, if you go to him, you'll never get audited. So I go to this guy and basically I might as well have gone to TurboTax, right? He was at any point was not willing to look at any potential deduction. The reality is that, most of the tax code is not all black and white, right? It is like gray. So you have to get people who are very comfortable with the law and make some decisions that can potentially save you money. Now, I want to be very clear here that I'm not talking about tax tax fraud. I'm talking about taking the tax law and interpreting it properly. And if you do that, that's a situation where you have a good tax professional. A good tax professional is not somebody who basically just tells you not to be able to take any deduction. That's just not the way it works. Okay, so the thing is that there are times when you are going to be doing things in the tax, with tax mitigation, that you're going to take some level of calculated risks too, right? So for example, our group got involved with syndicated conservation easements in the last few years. But, the reality is we all knew that there was risk. These things were basically charitable contributions, but essentially we're allowing you to take, they were basically giving you the opportunity to get 4 or 5 times more than the amount you contribute as write-offs. And that was because they were basing them on valuations, which seemed very legitimate, by the way. They were not being done willy-nilly. They were being done by professional companies. And this whole idea of conservation easements is in the tax code. So we knew that this was lawful. We knew that this was a huge advantage. However, even when we did these things, we all talked about it. We talked about what the risks were. And the risks were in part that the IRS has made it clear they don't like them. So they might come after them at some point, right? And so one of the thought processes there for a lot of people that I talked to was, hey, okay, they don't like them, but they're legal by the book. And even if they come after them, what could happen? well, they'll probably go to court and they'll probably settle, and it may take 5 years from now. So a lot of people ended up doing those anyway because their thought was, hey, by the time, I have to give any money back, I might have taken that original amount of money and doubled it. So there was a little sort of calculus that's involved in there that, it's okay to do. Now, on the other hand, you have to be really careful because even if you have situations that don't even have any particular gray area about them, for example, oil and gas, great opportunity. You've seen the laws for oil and gas over the years. It's one of the few places where you can get great advantages for people who are W-2 wage earners. However, the problem is that a lot of times those companies that are doing the drilling are a bunch of charlatans or there's criminal activity. So it's a tricky thing. Bottom line is there are plenty of ways to save on taxes, but there's no real shortcut. A lot of it is going to be taking some legitimate time to try to plan. As my friend Tom Wheelwright has said before, if you want to change your tax, you have to change your facts. And that's just a reality. Now, with that, I am going to present this interview with Eric Pierre today. Now, Eric provides a bunch of information here. I'm going to tell you right off the bat, I am not going to tell you they are right or wrong. If you are going to get involved with anything that he does, you're going to need to do your own due diligence. He talks about some fairly aggressive stuff here, and you'll find that I push back on some of the things that he mentions. It's probably worth getting the opinion of somebody else in this space, others than the usual ones that we bring on. So after these messages, we'll talk to Eric Pierre.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Eric Pierre. Eric is he's an Amazon best-selling author in a book called The Great Escape, which is essentially about personal taxes and small business taxes as well. He is a CPA, a second-generation CPA at that, former professional basketball player who brings a lot of his competitive nature to the field of tax. He graduated with a master's of professional accountancy from Stephen F. Austin State University and holds CPA licenses in both Texas and California. Welcome to the show.
Thank you, Buck. And yeah, my book, The Great Tax Escape, why making more money doesn't mean you have to pay more on taxes. I mean, you are making a great escape, though. I mean,
yeah, that's true. That's true.
And a lot of people don't like saying this word. So even I don't like saying this word sometimes, tax.
We actually, remarkably, believe it or not, talk quite a bit about taxes on the show. We generally talk about tax advantage investments, and we talk quite a bit about this space. And so it's not foreign to us, but it's a good idea to, sort of get different perspectives. First of all, tell us a little bit about how you ended up in tax. Obviously, you're a second-generation tax guy, but you were a professional basketball player. Who'd you play for?
So I played for the San Diego Guardians. Had I made the NBA, I probably wouldn't be doing this. I'd probably just be an investor. What happened was, in high school, I grew up in Katy, Texas. And so I'm, shooting the basketball and working on my dunk package, which means I really don't have a dunk package. I could do two hand, one hand, and a half tomahawk, okay? And my dad said, son, I'm not getting any letters from Dean Smith, who was the coach at North Carolina, for younger guys, young men and women listening, right? Roy Williams, who was the coach at Kansas, Jim Herrick, the coach at UCLA at the time, Did not get a letter from David Stern talking about being a lottery pick out of high school. So he said, you may want to have a backup plan in case
Plan
this
B.
doesn't work
Yeah.
out, right?
Yeah.
Because usually, if you're going to be if you're an NBA prospect, they identify you by the time you're 15. Unless you're Anthony Davis having crazy growth spurt 1 year. My dad being an accountant, I researched his profession and I happen to be good with numbers. And I saw that it was a recession-proof job. So I was like, all right, I'll do that. Because,
Yeah.
it's either that or I was going to be a sportscaster. So I decided to take something a little more stable because sportscasting, you had to start out in place and live in places I didn't want to live because, my dad was not, Greg Gumbel or something that could get me a job at NBC right out of college,
It's curious. Have you felt like, just out of curiosity, is tax recession proof? Is accounting, being a CPA, is it completely recession proof?
Absolutely. Now, what I will say is, with AI,
Yeah.
that you have to be more specialized. The days of just being a tax turn shop to make a living.
Yeah, right.
Because
Right.
unless, I'm not willing to own an H&R Block, and that's low margin work and that's very seasonal. You can make a lot of money. I know people who own those things, but they've been doing it for a long time.
Well, part of the thing that occurred to me is, I've been following the Doge guys, with Elon Musk and stuff, and you've been talking about ways to eliminate sort of some of the, for the clients who don't need the more sophisticated stuff, just to go directly and file with the IRS instead of having to use the TurboTax or, or an H&R Block and stuff like that. It seems like that's like an entire potential elimination of, a certain kind of business.
Well, my target audience is more the people that make $500,000 and more of income and have high net worth of $2 million or more. So that stuff doesn't really shake me. Most of those people that need TurboTax aren't going to hire me anyway. We've had to tell them like, you don't need me. We've had some people come through. It's like, you're going to spend $2,000 and you just have one W-2. You should just file it yourself.
Oh, 100%. I get that. I'm just curious if you worry at all about, AI's role going forward into even more sophisticated stuff.
No, because for for my target audience, they're always going to need, advice that AI can't necessarily give, whether it's the advanced strategies, right? So I do some high-end strategies, particularly if you start making millions of dollars in non-W-2 income, where I can put you in a structured investment where you get an 8-to-1 deduction and defer your tax 15 years and create an arbitrage that when the tax is due, you should double or triple your money tax-free. Certain estate planning, because there's too many, for instance, I used to live in California. In California, there are over 30 trusts. AI is not going to be able to tell you which trust to do. It'll tell you which ones are available, but then you still need a personal interaction with an attorney and a tax consultant to figure out which one makes sense for you. So I decided before AI, we had heard of AI, just focus more on the higher end stuff.
Yeah. Well, let's talk about the higher end stuff because that's what, that's what we do. Let's start, I guess, with this question here. What specific techniques come to mind when you have somebody who's a W-2, $500,000 a year person that go beyond, of course, standard deductions? Because as you said, if you're just doing standard deductions, they don't need you. How are you going to, what are some of the things that come to mind when you talk to somebody who is in this boat?
Now, if you have a basic W-2 and you're not making that money, you don't need me. So let me just correct that. At $500,000 or more, if you talk about just W-2, we have, my team and I have some strategies, particularly around, charitable strategies where we can get you tax savers reduced in half or more and get you ROI, particularly live in a high tax state like California and New York, of 60% of every dollar you invest.
Well, let's talk about some of those because we all know that there's things there, and we've actually ventured into quite a bit of specific ones. What types of things are you referring to?
Well, one that just expired, I got my clients to work with. Have you heard of Novoderm?
No.
Okay, so Novoderm, just to give a high level without boring the audience, basically it was a product that was in clinical trials that treated burn victims. And so they hired a company to help raise funds to fund the research, but it got FDA approved this past year. So this was last year you could contribute to it. And you can, for every $1, you can get a $5 deduction on your Schedule A up to 50% of your AGI.
And why is that? Is it R&D or what is that?
Well, the tax code allows for certain, in other words, because they had a valuation what it could be worth. And so you're basically funding R&D, but it's not R&D credit. It's a charitable contributions, what the law allows for something like that to be done. And so I got quite a few clients to do that.
So maybe rather than using a specific name of a company, you could explain that concept a little bit better?
Well, I use the company because you can't contribute to that anymore.
Because I'm still not clear on like what that strategy is, like how
it's a
how it works.
it's a charitable given strategy. So there are strategies like that or conservation easements.
Conservation easements are getting destroyed, right? Everybody's getting audited right now.
Well, first of all, you can still do it. Second, the IRS is not allowed to have it as listed transaction because there's actually a specific code on that, and that was ruled in the tax court. But you asked me for examples. So I just want to give you an example so you can understand. So the IRS code, which by the way has 40% more words than the King James Bible, allows for certain charitable events where you can make an investment and get a multiple up to 5, in some instances 5, like Novoderm I mentioned, or others you can get 6 or 7 depending on the mechanism and what it's used for. When it, for conservation easements, you can still do it non-syndicated if you own the land. You have to hold it for a certain amount of time, but it's the way they change the law is more for wealthy people who buy land and own it. You have to remember Ted Turner did it, Jack Ma's done it, Donald Trump has done it. So if you're able to buy land for a few $1 million, it can work for you under the changes of the law recently. Another example, I invested in a film called Wish Dragon 2. The first one was, I believe, the second most watched animated movie on Netflix. And so you can use the film tax credit, and I got a 4-to-1 above the line deduction, no limit. And I got a large deduction off that. That movie's supposed to come out this year. You get the tax credit up front, and then when it makes money, then I get my dollars coming back. There are some risks with some of these strategies because that particular strategy, you are at risk if the movie fails. But I work with people that set you up in movies that will do well. This was done for, Rust, that movie. That movie's going to do really well because of the shooting with Alec Baldwin. There are some people I know that got to invest in that. They will see a nice return on investment on their money.
Right. How much do the techniques that you're talking about in general, how often are they kind of coming under, IRS attack? I guess that's one of the things that we often hear, and I've heard a million strategies, of course, and I'm not saying that they're wrong. I just, part of the big issue that people have, our group was significantly involved in myself with syndicated conservation easements. And for years and years, we did that.
I did them too for a few years, by the way.
Right. And as you know, right now, that's a place that, I personally would not recommend that anybody do a syndicated conservation easement, especially given right now, the IRS made it very clear that they don't like these things and basically going after every single one. So how do you determine which of these things that you're willing to expose clients to and which you're not?
Now, you can still do conservation easements, by the way, the ones they don't attack. If you do the fee simple, where you can get up to 30% AGI, they've established that they're okay with that for whatever reason.
Is that right?
Yes.
Because, all right. Because,
well, and to be clear, the ones that I do, they're also backed by companies like Barclays or Lloyd's of London. So if it goes bad, you're made whole. And so with any strategy that I present my clients, first of all, I'm part of a group in my book I refer to as my Redeem team. So we get probably pitched, 10, 20, 30, 40 of these things a year. Okay. But we scrutinize them as a group together after we hear them. And we also ask for people that send us these things, examples of either tax opinions particularly if you get the should, okay, not more than likely. We prefer the should opinions. We also have had strategies where we know for a fact that they have withstood IRS scrutiny. Like for the a strategy that I help the higher end clients. I know the IRS audited for the sub funds, no change, and there was not a conservation easement. There are also strategies involving life insurance where you can get basically out of pocket for next to nothing. That and I use that for estate planning. They just got a private letter ruling.
Well, premium finance life insurance, I don't know that there would be any issues with that.
It's not it's not premium finance. It's a term insurance you can get. You can use for estate planning, not for a tax deduction, but get it put inside a irrevocable life insurance trust or ILET, and you can get it done for under $100 for wealthy people. That particular strategy, it's not a tax deduction, but it's more for estate planning. But that has a private letter ruling now. So there are strategies involving micro captives that for some clients make sense. There's a particular company that I have a business relationship with. They have their own private letter ruling. So I make sure. Yeah, I know your face is.
I again, it's just, believe me, I have been.
Then who do you work with? Because we do our due diligence.
I've worked with a world famous.
Okay, but I'm just telling you, I work with people that we get. If you have a private letter ruling on certain strategies, as long as you follow the rules, you're allowed to do it.
I just know that micro captives have also taken a massive beating from the IRS.
Yes, but I work with micro captives that are based in Puerto Rico where they do have their private letter rulings. The IRS likes those in Puerto Rico, by the way. I've read them. So
yeah.
Now, I personally don't use them for my clients. They didn't like it because of the fees. But remember, a lot of insurance companies that we pay insurance premiums have their stuff for micro captives. Oil and gas companies use some sort of captive or micro captive, but those are usually buttoned up with some sort of private letter ruling before they get involved in them.
There's a potential sunset of some current estate tax exemptions. What are some of the ideas specifically that you have for that?
First of all, when it comes to estate planning, I would make sure that you know what you want to do because you're likely to die at some point, right? So what do you want to do with your assets when you're done? Because that's going to dictate what kind of plan you do. So right now I'm working with a client of mine in Philadelphia. He wants to have one, major trust, and then he's going to have two trusts where each kid has an asset that is invested in a hedge fund that's owned in that trust so that the kids aren't taxed on that income. And so everybody, it's like, how tall are you, by the way, if you don't mind me asking?
6'4".
Oh, you're pretty tall. I'm 6'8", but you and I likely don't wear the same clothes, but at least you and I both would shop at big and tall clothing stores, right? So
I get away with the regular stuff still.
Okay. Well, I'm broader shoulder than you, but the whole point is like you and I, we could wear similar looking suits, but my suit's going to fit different than yours because, I'm a 50 XL. I don't know what your chest size is. It's not too, I lift a lot of weights.
Yeah.
And so it's not a one size fit all. So the first thing is, what do you want to do with your assets? Who do you want to pass it? If it's your kids, if it's the charity, there's some people that don't want to give all their money to their kids. Some people don't have kids. Like right now, I'm single, unmarried. So my assets would probably go to my sister and to some churches and ministries that I'm close with. Now, God willing, pray for me to meet a wife. That will have to change. So that's the first thing, before you get into, because in some states you have over 30 trusts, but that's the first thing you have to know. What do you want to do with it? And then that drives how you plan. Because you can have two people that are worth $100 million, but they have two different lives and two different philosophies of how to disperse their assets. And also it's going to depend on what state you live in as well.
Right. Ideas on international tax strategies?
I don't really dive into that. I have worked with athletes that played basketball overseas. And, I always tell those ball players, make sure you file your taxes because a lot of countries have tax treaties in the United States where you can get credit for the taxes you paid over there. So I don't want to comment too much because those are unique situations, but you want to make sure you're consulting with the right people on that because there are opportunities to get tax credits on international taxation.
Right.
Oh, and one thing I do want to make sure make clear, if you own bank accounts overseas, you do have to report that in your FBAR, by the way.
Right.
You can get into real legal trouble for not doing that.
Let's review just so people understand. I talked about this a bunch, but I think it's always a useful thing to talk about, is the real estate professional designation. Why is that significant? Give us review that for us, if you would.
Okay, so at a high level, in fact, we just spoke to the IRS about this. I'm glad you're asking this. Just to let you know, a lot of the IRS agents don't even understand that status, which is pretty sad.
It can be good or it can be bad.
Well, no, it's good if you know it, if you show them all in their face. Because, for instance, I have a client that I'm working with, here in Austin. He had worked with a large firm. I don't want to say their name because they'll be mad at me. His firm did not classify him as a qualified real estate professional, even though he more than met the 750-hour rule. And by the way, if I don't want to get into detail, but you can also group all your real estate activity together because the agent I was with, they did not want him to claim real estate activity where he had less than 20%. But my colleague and I explained that if you meet the criteria, which my client is because he's an executive for a large brokerage, and that's all he does, you can get that, which means then when you're invested in deals where you have negative income from depreciation, particularly if you do the accelerated depreciation or cost segregation, then that can reduce your ordinary income. And so for this particular client, this wasn't done, and we had to fix that. And he's owed a refund of $290,000, which triggered an audit when we filed the amended return. But we're able to stand up on it, and we had a 2-hour call with the IRS yesterday. We will be given a summary. We have to give his hour log, but once that's done, he's going to get his money.
Yeah, the log itself. How important is it to have like literally a written diary?
It's very important because if it's audited, they will be asking for that. So, we have to get our client's calendar, and then we'll be able to get it. He's got all his meetings. So even though that the IRS, we could show them where he works, they still want to see that.
Yeah.
Okay. But it's pretty easy to document. So
yeah, just a review of that, because I think it's an important one. There is this designation called a real estate professional designation, and the real value of that, I think the way I like to talk about it is that it allows these quote unquote passive depreciation amounts to become activated. And so effectively, you're able to create these massive amounts of losses that are just on paper, and they actually become active. That is different from somebody who is not a real estate professional, because typically what happens in those cases is you've got people who get a K-1 and they may get losses on there, but they can only use those losses against other passive income. So they must have other passive income. And some of that, of course, could be income from the property itself. But this is obviously, I've always called this sort of the holy grail, whereas if you can be the real estate professional and have huge amounts of losses that are active, any income that's coming in from anywhere is basically, you can use that depreciation towards it. So obviously huge.
By the way, you could also be married to somebody that has that status than your spouse. So, as a single guy, I guess I need to look for a single realtor, huh?
Mm. But generally, realtors aren't the best idea for it either, because realtors, having a real estate license is not even a useful thing here, right? It's basically you have to own real estate yourself. So that's the big kicker. Well, so then the question is there anything reminiscent of that kind of opportunity, activating huge amounts of depreciation for somebody who's got a job.
I mean, you can get a solar tax credit, and not the type that you install panels on your home. If you're high income, there are solar credits available. Now it's subject to limitations if it's W-2. So I believe if you're married, I think it's $560. But if you make $400,000 or $500,000 in W-2, you could potentially get that depreciation to get a substantial tax benefit.
So explain that again. So you're getting solar panels on your house.
No. This is not solar panels on your house. You're investing in a solar property, right, of some sort.
Like a solar business or what?
Yeah,
what kind?
something like a property, right? So it depends on how it's written. So I'm just talking general terms, so that we'll just say solar business for the purpose of this conversation, just to make it easy. So you can invest, let's say, $200,000, and you can get federal income depreciation and state tax benefit of like $300,000 in year one, which could offset your income. And these solar tax credits, as long as they're given the credit of 30-40% plus depreciation, which the IRS has very specific rules, and the federal government likes these things, that's a great way to take advantage of accelerated depreciation that's not real estate, where you can get that depreciation that you're looking for.
Another idea. What do you think? If I were a W-2 guy, I would be looking at short-term rentals.
Because you don't have to have the real estate professional status.
Exactly. And you literally get to use, as long as you fit the criteria for, somebody who manages one of those. And of course, there's a list of things you need to do there as well. You can do a cost segregation analysis, take bonus depreciation, and then basically take those losses. Am I right?
Yeah, you also to make sure you don't stay there very much as well, because you can't be
right. It has its own set of rules.
Correct, because people do have vacations that they use for STRs, so make sure that you're not. There's rules of how long you can stay there to do that. And of course, if you're looking to grow something like that tax free, you could always look at using self-directed IRA or self-directed Roth to invest in that if you want to grow something tax-free without worrying about the depreciation, if that's a problem for you.
Well, then you wouldn't get the depreciation then if you bought it with a self-directed.
Yeah, but for some people it might be difficult for them to qualify for that, but the upside might be worth more in retirement.
Yeah, right. But I mean specifically investments that can potentially help with tax mitigation. So if you're doing this as a tax mitigation strategy, you're not gonna do it via your IRA.
Well, you can mitigate your retirement tax. So
yeah, right.
Because you remember, taxes are going to go up as we get older, more likely, with our deficit increasing right now.
So you're saying that you can apply depreciation to your...
No, you can't apply to retirement. You just can grow it with that. Because remember, the downside to depreciation strategies is that there's the recapture. So that's what you have to take a look at and make sure it makes sense.
Right. Well, that's sort of the golden hamster wheel that we talk about on this show, where, you're constantly pushing it down the hill. But I think, again, I would just say for those people out there, just for value purposes, if you are a high paid W-2, one of the things you really can, and I would be looking for, is these short-term rental opportunities, because there's upside there as a rental that's reality. And you can take these same benefits that somebody who's doing real estate on as a real estate professional can. What are your thoughts on oil and gas?
I love it.
Yeah.
It took care of my family. My dad.
He's an oil and gas guy, or?
Yeah, my dad did oil and gas accounting.
I see.
You have a soft spot in my heart. I tend to fill up like at either Costco or Shell. My dad retired with Shell Oil. So I do love that, because that is a good depreciation strategy. You get a big chunk of it up front in year one.
This is still basically 100%.
It's like 80 or 90 but
for drilling, right? For the
IDC, the intangible drilling cost. Yeah,
right.
I'm invested in one personally.
Yeah. My problem with oil and gas, I have to tell you, is I have invested in it multiple times and I've never made any money. So I think
it depends who you invest in, because I know companies that
I'm sure there is. I'm sure there's ones that.
Yeah.
But it's also just a space full of charlatans, so you got to be very careful. Right.
Yeah. Well, yeah, because I know a group based, and I've actually been to a facility in Mexico.
Yeah.
They invest a lot of capital. Like the cost of drilling is really low with all the technology. So
Yeah.
the arbitrage to make money with the right company is out there now, since it doesn't cost nearly as much. And with the computers, for most spots, you can see where the stuff is at before you go drill in a dry hole.
Yeah. Well, one more question for you. Obviously, we're in 2025, new year, new administration. So what should high income earners be focusing on?
Man, that's a great question. I'll be focusing on planning as soon as possible, and then make sure your tax professional is staying up to date on changes. And the one thing too, when I say that, there's a lot of stuff being thrown out right now. And the one thing I can say is that if nothing has changed, the current tax laws that we're using that is known as the Trump tax law, right? The tax cut job act, we call it Trump tax law. That sunsets on January 1, 2026. So I would be looking, if you're high net worth. So right now, I believe married couples have about 24, 26 million exemption for federal estate tax. Single people about 13. I would look at your estate planning closely, because if nothing is done, then it's going to be probably cut in half, a little less. And so I would look at your estate planning, make sure that you're ready in case it goes down, because there's no guarantee that, President Trump wants to extend the tax cuts, but he may not have the congressional support to do that. So I know estate planning attorneys probably hope that doesn't happen, because then they're back in business.
Yeah.
But I would definitely take a look at that right now. That's something I would take a hard look at.
Well, Eric, the book again is The Great Tax Escape, available on Amazon, obviously. And really appreciate your time today on Wealth Formula Podcast.
Thanks, Buck.
You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. Just a quick note, make sure you join the Accredited Investor Club. Lots of opportunities coming up this year. And hope you enjoyed this show and take your tax planning seriously. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.